All right, welcome to the December 5th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk a bit about the latest data from the USDA's Fats and Oils report, and then we're going to look at feedstock prices, relative feedstock prices, and our estimates of the profitability of producing biofuel from those feedstocks. First, of course, I'll give you a quick update on South America. It seems like conditions in central Brazil have improved a bit. That comes basically from me looking at the radar every once in a while, and then also I think the movement in prices would also suggest that at least there's a little bit less concern. I was talking to Joao this morning about planning progress in Argentina, and that was surprisingly not as far below the 5-year average as we both thought. They're a little less than 50% done, and that's about 7% below the 5-year average, but of course, well ahead of last year's pace, which was impacted by drought. The market still is going to worry about growing conditions in both Argentina and Brazil until we really get to the spot where we're starting to fill pods and we can kind of see what the weather forecast looks like. I know that early in the season, analysts, and I do this too, will want to sort of adjust their yields based on poor early season growing conditions. And, I know I've said this on this call a lot, but you can make really good soybean yields with really ugly plants as long as they get rain at the right time. So we haven't cut our forecast yet. Other analysts have cut their forecast. We're at the upper end of the range. We were already at the upper end of the range. And so ultimately, we may have to cut our projections, but just given sort of what happened in Brazil last year, I'm a little hesitant to be too aggressive about cutting yield forecasts, just because, again, if it starts to rain, then things can look a lot different down there in a relatively short period of time. Okay, let's get on with the show. All right. So the biggest, I guess, surprise, although the NOPA data suggested it as well, was the soybean oil stocks number, which dropped to just over 1.5 billion pounds. You can see that's the lowest it has ever been since USDA picked up reporting of soybean oil stocks and soybean crush in May of 2015. So the lowest in at least 8 years. And you can also see that large crush and large demand means a lot of variability during the marketing year. You can see our forecast range really from 3 billion pounds down to probably 1.7 billion and over the same season. And again, that really has a lot to do with big crush volume sort of building inventories early in the marketing year, and then those inventories getting drawn down through the rest of the marketing year. The crushing volume for October was a record for any month, and so we are starting to see the U.S. kind of get into, and I suppose this isn't really new, but the U.S. getting into what we've talked about a lot with Canada and the preference for crushing canola seed rather than exporting canola seed. The U.S. is getting there as well. I don't know that we will ever get to be in the same spot as Canada, just because soybeans are such an important input, I suppose, to the Chinese feed industry. And while, again, I think probably Canada will diversify, and like I talked about last week, they're starting to buy soybeans from South Africa. They probably will try and find some new sources to replace the soybeans or at least partially replace the soybeans that they were getting from the US, but they certainly still will take soybeans from the US no matter how hard it is to get them out of the US and whatever political tensions there are between the US and Chinese governments, because the Chinese government remains really and sort of acutely worried about food security. And so while I think that rising crushing volumes in the US mean that in the years ahead, as we sort of adjust our demand forecasts based on what we think is going to happen with production, those adjustments will primarily fall on exports, with oil demand really determining where we set crush each year, oil demand and crushing capacity. And then whatever adjustments we need to make, either higher or lower, will come mostly from adjusting our prediction for soybean exports. However, even though we have expectations for record crush, it doesn't necessarily mean that that we're going to see soybean oil stocks build up to, I mean, at least temporarily, they'll build to really high levels, but then the strong demand for soybean oil from biomass-based diesel producers will draw those stocks down over the course of the year. It's hard to imagine that if every year we sort of drop below 2 billion pounds by the end of the year, that doesn't support soybean oil prices at or above where they are currently, both on the future side, which I think probably has made a lot of the adjustments it needs to make based on the big run up we saw in prices, and then the prices coming back down into around where we think probably fair value is for soybean oil. I think that that variability in stocks, even though you may get a record large stock number in one marketing year, you may also get a low stock number in that same marketing year. And even though you get the record large, prices really are priced at the average. And so strong demand, tight use means that prices are going to have to go to a level that will in some ways ration a little bit of the demand. Although as we go through our feedstock demand forecast, it has gotten easier over the last couple of months to balance those without having to include a whole bunch of renewable diesel or soybean oil or canola oil. I just went through canola oil recently and ended up just taking a lot out. I actually had to go back for the months that the EIA reported canola oil use in biomass-based diesel production before they started breaking it out, to kind of adjust our forecast backwards to make sure that they sort of met up with what has been reported. So if we had, and this wasn't the case, but if we had sort of 10% of the total going to renewable diesel production, and then in the 2 months they reported it was more like 50%, we went back and adjusted that 10 up to 50. And when we did that, there actually was more canola oil used than our model would have suggested. And so we're going to go through and try and change that maybe a little bit to favor canola oil more. But over the last couple of years, most of the time that I've spent on that stuff has been trying to sort of balance out the demand with vegetable oil, because there weren't sufficient fats and greases. Now, the growth in imports in tallow have helped a lot with that. That's trees don't grow to the sky or to the sun or moon or whatever that saying is. And so eventually that growth is gonna stop, and then there will need to be something else that supports the growth in feedstock demand. But at least at the moment, it seems a little bit easier to balance the feedstock demand than it has over the last couple of years, certainly. And we're starting to learn more, right? The EIA is breaking out the soybean oil, canola oil, and DCO into biodiesel and renewable diesel usage, and hopefully in the coming months they'll do the same for the fats and greases. All right, so what has become, I suppose, my favorite chart, average soybean meal demand. You can see that the implied soybean meal demand was a little bit stronger from the USDA than it was from NOPA, and it was essentially equal to last year at 117,000 short tons per day. And if you look at, I was looking at soybean meal basis, and if you look at what happened in the basis in September and then in October and November, you saw basis come down quite a bit and then go straight back up. And I think in November, or October or November, it averaged 45 over or something crazy like that. So it does seem like soybean meal demand, at least for the moment, might be a little bit stronger than it was late in the summer. And so if that's the case, we'll get back to this idea of crushers crushing to meet soybean meal demand and trying to maintain margins in vegetable oil or soybean oil. If you are a buyer of vegetable oil, which I'm sure many of you are, then this is a great argument to make against or not against, but with your supplier to say that, hey, I know soybean meal demand is really strong, but so far, I guess with oil stocks at multi-year lows, it's a little tough to make that argument. But I know soybean meal demand is really strong, and so I know you guys are crushing to meet the meal demand, and you're producing however much oil you produce. Let me have it cheaper. That doesn't sound quite as good, again, with soybean oil stocks where they are. But if I had to buy vegetable oil, the thing that I would worry most about is a slowdown in this demand right here, because I think that the adjustment from crushers crushing to meet meal demand and crushers crushing to meet oil demand is probably going to be a little bit sloppy. And that probably means that prices are going to be a little bit more volatile, and basis is probably going to be a little bit higher during that period than it would otherwise be, just in part because the way that the crusher's business works, their margin comes from either meal or oil, and if they're losing meal demand, and meal makes up the majority of the value of crush, they're going to need to try and figure out what the market will bear in terms of oil basis, or I guess what the market requires in terms of oil basis to incentivize them to crush enough beans to meet the oil demand, and then deal with however much excess soybean meal they produce from that. Part of that obviously will go to the export market. Part of it also will kind of show up as stronger meal demand, because as crushers start to produce excess meal, then protein meal prices broadly are going to come under pressure. And so soybean meal probably will come under pressure too, and that probably will encourage a little bit more. It'll probably raise the inclusion rates for soybean meal in feedstock mixes or feed mixes, and that will make it look like maybe they're still crushing for meal, even though they are truly crushing for oil and trying to figure out what to do with the meal. And it's that, what do we do with the meal part, that I think is going to, or has the potential to make that transition relatively messy. We expect meal demand to remain strong. We expect year-over-year growth to be 3.6%. And October's demand or implied domestic usage was just shy of the record set last October, actually. And I think last October was 3.64 million, and this October was 3.63, but it was really like 3.637 or something, and last year was 3.637 or something like that. Anyway, You will see this chart a lot more, probably almost every month until we're all convinced that crushers are actually crushing for oil as opposed to meal. All right, the next couple of charts are just going to look at the average daily usage of soybean oil in biomass-based diesel production. You can see that we have soybean oil used in biodiesel down a bit relative to the last couple of years and relative to the 5-year average. That primarily has to do with our assumptions about biodiesel production in 2024. And I still am not, I go back and forth almost every day. There's a lot of reasons that I think it makes sense to keep biodiesel production relatively close to last year's level, at the very least for 2024. And then when we get to the margin data later, there are some good reasons to suspect that biodiesel production might slow in 2024. I think a big part of that obviously will have to do with RIN prices and whether they rebound a bit. But the RIN situation is one that I think is pretty interesting, in part because of what we talked about last week, where if you look at the RIN generation versus the mandates, or if you look at the gallon production versus the mandated, the volumetric mandates, which again are not exactly the mandates, but are close enough, especially even though we're getting close to the end of the year. But they're close enough for our analysis right now. And even if that suggests that that we don't have enough RINs, one, there's a bunch of carryover RINs, and then two, again, it's really D4 that's sort of driving the whole market. And I know that that's sort of always true, but D4, the D4 overproduction that we've talked about a lot, is really pressuring D6 prices and kind of making it seem like we probably have a lot more coverage on the mandates than we actually do. If you just told me where RIN prices were and said, okay, what do you think biomass-based diesel, or what do you think biofuel production is going to be relative to the mandates, I would say, oh, it must be 1 billion gallons above or 500 million gallons above instead of 300 million below. And that that suggests that maybe maybe a little bit of biodiesel capacity will need to be rationalized, or just will be rationalized. Now, if that's the case, then ultimately that will drive RIN prices higher, and depending on how much it happens, it could drive RIN prices substantially higher. That'll be really, really difficult because of the production in D4 and the overproduction in D4. But it's something that could happen. So what I've done is I've taken the worst choice, really, which is somewhere between the two. I haven't really cut domestic biodiesel capacity significantly. The same with year-over-year changes in biodiesel production. We've talked about that a couple of times, but I haven't gone fully on with we're going to just keep producing biodiesel at the same rate that we've been producing it either. And so this chart kind of, it reflects where we are now, but I think that there's a chance that soybean oil usage could be higher, and I think it could be lower. And I can make, I think, compelling arguments for either. So we'll kind of see what happens in the first couple of months, and then we'll kind of go from there. But if margins don't improve, it's going to be really easy to decide. And renewable diesel production, I remember when I put this chart together initially, I had just gotten out of a class on amazing PowerPoint presentations. And so one of the things was to not go with a boring title like I've used here, but to make a point with your title or whatever, something to draw your audience in. And the title on this one was, will soybean use and renewable diesel production accelerate over the summer? And we did see that. not quite as much as we thought, but not far off. I think in our chart before this, when it was like April or May, or early in the summer, we had the peak usage at about 19.5 million pounds a day. It ended September just under that, and we expect it sort of to continue to grow and actually grow pretty substantially over the next year. That said, soybean oil, and I think in particular to get prepared for the transition from the blender's tax credit to the Inflation Reduction Act credits, I think there could be a little bit later in the year, and maybe it happens after the 23-24 marketing year is over, so October of 24. But I think there probably will be at least a bit of a shift away, at least initially, from soybean oil. So it may be that if we added 24, 25 to this chart, ultimately what we'll see is a decrease year over year in soybean oil use. That said, of course, it would be hard or nearly impossible to replace all of the vegetable oil that we use as feedstocks for biomass-based diesel production. Even if you just took soybean oil out, you're going to need to find more than 1 billion pounds a month of feedstock to replace the volume of soybean oil used each month in production. And given that most of the fats and greases have a relatively fixed supply, I think that would be relatively difficult. There is one source that could potentially offset at least a substantial portion of the potential soybean oil usage that's lost, and that would be used cooking oil, particularly used cooking oil from China. As the certification business, the traceability business develops and the industry becomes more confident in the source of Chinese UCO, then I would expect that, particularly after we shift to the IRA credits, because while the IRA credit does not pay for imported biofuel, it does pay for imported feedstocks that are then turned into biofuel domestically. And so you could see real pressure on US import demand for UCO. And at the same time, I would expect that probably would replace soybean oil or canola oil or other, I suppose, high CI feedstocks. And that may help eliminate some of the pressure from soybean oil demand. However, for the purposes of this chart and for the next marketing year, it's hard to imagine that unless we see a big slowdown in production, it's hard to imagine that soybean oil used in renewable diesel production will not grow pretty significantly in the next marketing year, sort of the same way we saw it this past year. If you look at the chart, you can see last year started out at about 7.5 and ended up 7.5 million pounds a day and ended up above 15. So more than double the demand for soybean oil for renewable diesel production in a year. Oh, sorry, I went backwards. All right. And so while Chinese UCO probably is going to be one of the major sources of additional supply in the coming years, so are US vegetable oil imports. Of course, a lot of this is canola from Canada, but US imports of fats, oils, and or I should say fats, vegetable oils, and greases has basically switched from, we were modest exporters for a long time. And then 3 years ago, we switched to modest importers, and then back to net exporters in 2020 because of the pandemic. And then since then, imports have grown pretty substantially, and our net trade balance across all feedstocks shot from something like 500 million pounds of net imports to like 4 billion or more than that. I don't remember the exact number, but the amount of growth that we've seen in feedstock imports has been eye-popping over the last couple of years, and that's likely to continue even after we switch to the blender's tax credit. Like I said, unless we really start to import a lot of fats and greases from around the world, soybean oil and canola oil are going to be required in large volumes. And even if we're not importing vegetable oil to produce biomass-based diesel, we'll need to import it to substitute for the soybean oil, canola oil that's going into biomass-based diesel production. But it looks like to us for next year that we're going to be about 400 million pounds per month above the 5-year average. So a little bit more than 500 million pounds above where, or a little, sorry, about 400 million pounds above where we were on average over the last 5 years. I was trying to say something else and then I realized I couldn't. So sorry, I said the same thing twice. This, of course, will provide some relief on prices. However, U.S. prices will naturally attract imports, and the imports will come as long as prices make that economically feasible to do so. So to the extent that there is any relief on prices from imports, it probably will be relatively minor, but additional supply is additional supply. And the U.S. is going to become an importing country and maybe a big importing country. I haven't looked to see the largest vegetable oil importer is India, and I haven't looked to see what that number is to see. Again, it's a little different because a lot of our imports are fats and greases, and they are the largest vegetable oil importer. I don't know that we'll compete with them on the size of vegetable oil imports, but I would imagine if you included the fats and greases, they probably don't import a lot of Chinese UCO. All right, so what does that mean for our price outlook? This is just a chart showing the difference between soybean oil and other feedstock prices. The red line suggests that those prices would be at a premium. The lines that are below that suggest that those feedstocks would be at a premium to soybean oil. So you can see the vast majority we expect to remain at a discount to soybean oil over the next year. However, the discount has actually gotten a little bit bigger over the last month or so. There was a point where I was kind of having to manually move the used cooking oil line above soybean oil because the model wanted to take the price down below soybean oil, but given the weird economic incentives that would set up, we're always going to maintain UCO above soybean oil. Maybe it will trade below soybean oil one day for a short period, but I can't imagine that being a trend that happens over an extended period. Again, just because it would essentially say, I'm going to buy some soybean oil, I'm going to heat it up and use it to cook some fries, and then it's going to become more valuable after I have used it. Now, I could argue that, okay, well, when you're making fries, you don't get the credit value and the incentives that come along with biofuels, and so that's a reason that used cooking oil actually could be more expensive than soybean oil. However, those incentives apply to the broader soybean oil usage anyway, and so those incentives should at least be reflected in the price in the same way that they are in feedstock prices, in the broader price in feedstock prices, but to a smaller degree, because at this point only roughly half of like soybean oil is going into biomass-based diesel production. So if you think about it sort of like this, like if you're buying feedstock for a renewable diesel plant, most of the value from the credits you're going to either get or create when you make renewable diesel, And so that price should reflect in some sense the full weight of those credits. Whereas if you're buying soybean oil to make potato chips, then you don't necessarily get those, and that price should also reflect that a little bit. Now, there aren't two different prices for soybean oil, or at least we don't talk. There's actually a lot of different prices based on how well each buyer does it at each individual company. But we only talk about one, and so it's kind of an amalgamation of the two values in use and the credit values for those. Anyway, that was probably more than we needed to discuss that. The two that we expect to be premium are DCO and DCO and tallow, of course. You can see that they both have been premium to soybean oil in the past couple of years, particularly, and really since the build out of renewable diesel capacity have both become much more valued and much more used. In particular, tallow, although DCO is certainly represents a large portion of the feedstock mix as well. The interesting bit about this chart, I think, is the spread between the bulk of the feedstocks and tallow and DCO. DCO has gone back and forth a little bit. I think it probably it has sort of the double whammy from the change in credit prices. So DCO becomes worth less when D4 RINs go down and LCFS credits go down, but ethanol prices and the economics of producing ethanol also decline with D4 RIN prices, even because D6 trades below D4. And so you also get less supply of DCO as a result of those changes. So it's that one is a tough one. And as you can kind of see on there, it tends to be relatively volatile. So that one, it wouldn't necessarily surprise me if DCO remained at parity or close to parity with soybean oil, while tallow remained at a premium. I understand the tallow premium. That makes all the sense in the world to me, given the growth that we've seen in imports. DCO, I get a little bit because of the gap between ethanol production and the mandate. However, it's not like we're producing a lot less DCO than we have in the past. Ethanol production is not down that much from the peak. So if ethanol production continues to decline, then DCO at a premium to soybean oil makes a lot of sense, given its popularity as a feedstock. But if ethanol production comes roaring back, then I would argue that DCO probably trades at a discount to soybean oil. Okay, and on to profitability. This is soybean oil used to make biodiesel in different regions. And at this point, there is only one region where that, at least our estimate of the profitability of production is actually profitable. And that, of course, is the California region. Given what these margins look like over the last couple of months, it's a little surprising how well biodiesel production has hung in there, especially if you just kind of look. I mean, biodiesel production was sort of marginally profitable across most regions before we really had this build out, and then it kind of has varied around between this level of sort of 50-cent losses, 50 cent to $1 gains, and now we're somewhere between 0 and 50, or just below, or I guess we're between -50 and 50 across all of them. Individual companies, of course, will have different cost structures. And so they're given how little most of the regions are below the break-even point, it wouldn't necessarily be surprising if there wasn't a little bit of profitability in more regions than this graph suggests. In addition, we used the average CI score for the pathways approved under the LCFS program to calculate the value of the LCFS credit in this analysis. And it may be that individual facilities have either higher or lower CI scores, and so their profitability would either be lower or higher, depending on exactly where their CI score is. A lot of the weakness, I think, in biodiesel margins in the last several weeks or so has been from a readjustment once again in the price of biodiesel relative to renewable diesel in the California market. Of course, the rest of the regions don't exactly move along with the California market, but I think that move does reflect sort of broader strength or weaknesses in the margins. And so it may also be that that there is a bit more profitability than this suggests. And I hope that's all I have to say about that chart. All right, for renewable diesel, the volatility, or I guess the spread between the different feedstocks since we've really had the big build out has obviously increased. There has been very few times that anything other than canola oil or soybean oil has been negative in our assessments. Oddly, the only other one has been distillers corn oil, and those three are kind of grouped together at the lower end of the range of profitability. It looks like most feedstocks are starting to roll over a little bit. Again, energy prices will have a big impact on this, and in that shift back towards renewable diesel may suggest that that profitability is held up a little bit better than it sort of should have, not necessarily should have, but then it otherwise would if the spread between renewable diesel and biodiesel was just unchanged and just steady at like 5 cents over, 2 cents over, or whatever. I think that has at various times obviously hurt renewable diesel profitability, or our assessment of renewable diesel profitability. In the last couple months, these big moves up have a lot to do with that change in the relative price of the two. If this is where the relative profitability of renewable diesel production is against biodiesel production in the long run, so not just next week or the next several months or the next quarter or year, but over the next 5 to 10 years, let's say, that renewable diesel margins kind of look like this and biodiesel margins look like this, then it becomes a lot easier for me to make a decision about biodiesel capacity and biodiesel production, because then I would just sort of run it down. And while I am really confident in the fact that there will be biodiesel capacity after the industry sort of absorbs the growth in renewable diesel capacity, and by that I mean biodiesel capacity beyond the integrated producers. While I think that's true, I've always felt that if the market really convinced biodiesel producers that margins were going to be flat or negative going forward for a substantial period of time, that would be the time that I would really start cutting into biodiesel production capacity, or our estimates, our predictions of biodiesel production capacity. If this is where they ended up, that choice and that exercise would be a lot easier, just because if biodiesel margins are going to be negligible, then then I think there probably are either producers out there that would convert some or a significant portion of their capacity to renewable diesel or vegetable oil refining, or close the plant down in some cases. And I think there will be, again, some producers, the integrated producers will survive. Smaller regional producers that again have a niche either geographically for their product or have some geographic advantage for feedstock. They probably will do pretty well too. In whether I predicted that those would close down or not would depend on a lot on how the relative profitability in this chart and in the prior chart. And so if it's really relatively, if it's close, then I would probably taper biodiesel production off more slowly. Again, post 2025, we're kind of going to have to get there and see what happens. If biodiesel margins for all the feedstocks or for all the regions were positive and in the spread was 10 cents to 55 cents, then I would do the opposite, and I probably would maintain biodiesel capacity right at where it is today, or with some very, very small reductions in biodiesel production capacity. I'm sorry, that was biodiesel profitability in the California market. Everything else I said still holds true, except this is what renewable diesel profitability looks like in the California market. The obvious spread between UCO and yellow grease and everything else is just down to the CI scores, and it is held relatively steady throughout this chart, and this is exactly what's going to drive UCO imports from China and from the rest of the world. And maybe there are 1 billion pounds of UCO out there each month that the US can source to replace soybean oil and canola oil. I think that's a big ask, but if this is the difference in profitability between the California market in renewable diesel more broadly and biodiesel, then this chart really argues that one, we will import a lot more UCO, and two, that sort of what I said about the last chart, if this is kind of where renewable diesel margins are and biodiesel margins are marginally positive or negative, then probably a slow decline in biodiesel capacity makes sense. If these margins improve substantially or biodiesel margins declined significantly, accelerate that, and then of course going the other way. The one thing here that I think is a bit interesting is the rise in the profitability of choice white grease. I've been a little surprised, and we've talked about it a couple of times, about how limited the demand for choice white greases from biomass-based diesel producers. The relative profitability hasn't always been fantastic, but it's certainly been at the upper end of the range. I imagine choice white grease is not as easy to work with as some of the other feedstocks, and so that probably contributes a bit to it. But it just that's been something that has surprised me. And if choice white grease is the third highest yielding or third most profitable feedstock, it seems like the demand from biodiesel producers, renewable diesel producers, would go up. But I've kind of been waiting for that for a while, because you can see choice white grease generally has been at the upper end of the range. And so if you look at that versus the blue line, which is kind of hidden a lot of the time, but distillers corn oil, which is closer to or behind poultry fat a lot, it looks like. distillers corn oil is really, really popular. And at least us, it doesn't look like it has been more profitable than choice white grease for a lot of the time. So the choice white grease thing has been something that I've sort of wondered about for a while, and I will do some digging into that in the next time that we write about choice white grease. I'll address it in our webinar. All right. With that, I'll open it up. Somebody else asked me a question. Oh, almost made it on time today. With technical tallow at a 2-year low, how long do you expect it to last? So broadly, there are a couple of, this is a really good question. There are a couple of opposing forces at work on the feedstock markets and feedstock prices right now. One, you have the growth in demand, but that's balanced off a little bit by the general impression that margins in the biomass-based diesel industry are not that high, and so because of that, that demand is slowing. So on one hand, it's hard to argue with more than 1 billion pounds a month of soybean oil demand. But on the other hand, if you look at RIN prices, you look and you say, well, that demand probably is, or at least the growth in that demand is probably slowing a bit. On the other side, you have a situation where we are using so much of the US supply of feedstocks and biomass-based diesel production that our imports have risen as much as they have. And that suggests that prices kind of could be and should be higher. But the limit from biomass-based diesel production margins kind of are, I guess, maybe a way to think about it is like this. If you think about biodiesel production margins as sort of an indicator of sentiment, then when RIN prices are low and margins are down, the market is kind of blue, and it's tough to get prices to rally unless you have an exogenous supply threat. So drought in Brazil and Argentina, that qualifies. We saw that last year. That contributed to higher prices last year than we would have otherwise seen as the market was working its way down from the boom highs, I guess. Those concerns could turn the market around at any second because the US stocks are so tight. And while the world vegetable oil supply and demand balance is much better than it's been in the last couple of years, it would only take the loss of really a significant portion of Brazil's crop or Argentina's crop to send oilseed futures, oilseed prices, vegetable oil futures, vegetable oil prices sharply higher, because the demand from the US is it's very tough to rationalize that biofuel feedstock demand. It's not impossible, and I think what we'll see over the next month or two as we get data from the EIA on vegetable oil usage in particular, use in biodiesel production, the production over the mandates is not necessarily guaranteed. So you could see a reduction in demand from that. But generally, there's a big chunk of demand for biomass-based diesel feedstocks that is mandated by law. And so that keeps prices from falling significantly further and will support them. But on the other side of that coin is the margins. And so if margins are poor, then it makes it tough for the market to rally. And then if you have concerns about a huge Brazilian crop coming, that makes it even tougher for the markets to rally. I think that if we really do, if the weather pattern has changed in South America, I think you're probably going to get soybean prices running down below $12 a bushel, and maybe even lower than that. And in that case, it becomes really hard to raise soybean oil prices, given that soybean oil, the value of soybean oil plus the value of meal has to equal the crush margin. The value of those two minus the cost of soybeans has to equal the crush margin. And that equation sort of holds true. And so if you think of it this way, and this is kind of what we do, if I have a couple of the answers to that equation, so there's basically four parts to that equation. There is the margin, then there's the cost of soybeans, and then the price of soybean meal and soybean oil, the value of those. If you've got three of those four, you can predict the other one. And so what we do is we take the crush margin and soybean prices, and then our soybean oil forecast, and then those will all imply the soybean meal price. Why am I talking so much about this? It's because when you take that soybean price down, you either have to take the price of the products down as well, take your crush margin up a lot, and crush margins are already historically high, or the product prices have to come down with the oil seed. And the most likely is that the product prices come down with oil seed. Now that's vegetable oils, and you asked about tallow, but that pressure from vegetable oils will also have an impact on the tallow market. Tallow prices certainly are set by the supply and demand of tallow, but they're also set by prices for competitive commodities. And generally, that ultimately leads back to soybean oil in some way. So pressure on soybean oil prices will limit the amount that tallow can rally, or any of the other feedstocks can really rally. That said, because tallow prices are determined by the supply and demand of tallow, if something happened and the new imports of tallow, or the new sources of imports of tallow, Australia is not really new, but in terms of, if you look at how much tallow we've imported from countries outside of Canada, all of those totals have gone up sharply over the last couple of years. And if you took those supplies away, if Australia came out tomorrow and said, we're going to have our own RFS and we're going to make the mandates whatever they make them, the amount of tallow that would be available to the export market would shrink. And that little bit of reduction in supplier, it's not little, it's significant, but it's not substantial. We don't get 50% of our tallow from Australia. But that little change in supply would have an oversized impact on prices, because everything is so tight right now. So while I say that watch soybean prices and watch what's going on in Brazil, because that'll give you a general tone for feedstock prices, the individual commodity supply and demand will also have a significant impact. To answer your question just very straightforwardly, I think that tallow prices probably remain under pressure. I don't know that they will stay quite as low as they are. I think we have them going up slowly. We have most of the feedstock prices going up slowly over the next year. And that's, I think, probably again, absent supply disruption or something like that, I think that's probably the most that tallow prices can really rise. And I think that there probably is a little bit of downside risk here, but probably not a ton of downside risk, especially given where we are in the cattle cycle, and the fact that cattle slaughter continues to sort of shrink year over year. I think that any threat to supply is going to make tallow prices, especially relative to soybean oil or anything else, would really make tallow prices take off. But there's nothing that I can see right now that would suggest to me that we would have a significant problem with U.S. tallow supplies. Oh, somebody else asked a question. Any comments on, yes. Oh, thank you for asking this. Whoever asked this, I really appreciate this question because I've been meaning to talk about it and I keep forgetting. Any comments on tallow's huge jump as a biomass-based diesel feedstock as reported in the EIA's feedstock report in the last 2 months? I have a colleague, former colleague, that called me right after the first report came out and said, "Does this make any sense to you?" And at that point, I hadn't really looked at the data in any great detail, and so I just said, I know that it is relatively close to the what I think the supply of tallow is. And so I can't imagine that this is sustainable. And then, of course, the EIA released the next monthly report with even more tallow usage. I have the way that our model works is we essentially have feedstock mix assumptions for all of the renewable diesel producers. And based on that feedstock mix, we get sort of an average feedstock mix for the industry. We multiply that by monthly production to get our feedstock demand forecasts and our feedstock use estimates. And based on that, it's really tough for me to cram enough tallow into renewable diesel production to meet the numbers that the EIA is reporting. Even tallow and biodiesel combined, what I end up with are numbers that look really, really crazy for biodiesel, like 200 million pounds of tallow used in biodiesel or something like that. So I don't mean to say that the EIA numbers are wrong somehow. If anything, I think that I'm probably missing something. And so I this is one that's really interesting. I take the EIA at face value. They may go back and adjust it, but I don't know where we're getting the additional tallow, I guess. I am this, like I said, this is something that I'm curious about, and so I am digging into it. And as I come up with more answers, I will let you know. But thanks, really, thanks for asking that question. I've been meaning to talk about that for a while. All right. Thank you, everybody. I hope everybody has a wonderful day and a great weekend. And I will see you all next week, or you'll see me next week. Bye-bye.